3 warning signs. Before every economic collapse, the illusion of stability, September 2008, quiet neighborhood in Pennsylvania, a 53-year-old electrical engineer wakes up before sunrise. Coffee, news, commute, routine. He has done everything right. 19 years at the same manufacturing firm. A modest 3-bedroom home purchased in the late 90s. A 30-year mortgage paid on time. A wife who teaches 4th grade. A daughter studying at Penn State. A retirement account built slowly, responsibly, paycheck after paycheck. He didn't speculate. He didn't gamble in the stock market. He followed the formula handed down for generations. Work hard. Save consistently. Trust the system. 3 days later, Lehman Brothers collapses. Headlines explode. Markets convulse. Within weeks, his retirement savings drop nearly 40%. Within months, layoffs begin. Soon, he is unemployed. Within a year, his home is worth less than the debt attached to it. He did nothing reckless. So what actually failed? It wasn't just a bank. It wasn't just a housing bubble. It wasn't even just Wall Street. It was structural decay, years in the making, hidden beneath the appearance of prosperity. Because economic collapses do not begin with crashes. They begin with confidence. Most people imagine financial disasters like earthquakes, sudden, violent, unpredictable. That is wrong. Collapses are closer to bridge failures. Steel beams weaken slowly, bolts corrode invisibly, traffic increases, inspections become optimistic. The bridge still stands, cars still cross, officials still reassure, until one morning it doesn't. The most dangerous phase of any economy is not the panic. It is the final stretch before it, when everything looks stable, stocks rising, credit flowing, unemployment manageable, optimism high. That phase has a name in financial history, the blow-off top, the final surge before gravity returns. And behind every major collapse, from the crash preceding the Great Depression to Japan's crisis after the Plaza Accord to the chain reaction during the Asian financial crisis, 3 warning signs appeared. Not similar signs, the same signs. The first is subtle. It isn't a headline number, it's a relationship. The relationship between debt growth and real economic growth. In a healthy economy, credit fuels production. A company borrows to build a factory. The factory produces goods. Goods create income. Income repays the loan. Debt justified by productivity. But when borrowing begins to outpace the economy's ability to generate real output, something shifts. Credit expands faster than wages, faster than GDP, faster than productivity. The extra money doesn't build factories. It buys assets. It funds speculation. It refinances old debt. The obligations grow. The productive base does not. Mathematically, this cannot continue forever. During the late 1920s in the United States, borrowing exploded while real output grew modestly. Margin debt, money borrowed to buy stocks, reached record levels. Consumers purchased radios and automobiles on installment plans. Prosperity looked unstoppable, until it wasn't. In 1980s, Japan, easy money policies triggered a lending frenzy. Real estate prices soared beyond imagination. At the peak, land in Tokyo was valued at absurd multiples of global benchmarks. The stock market index climbed vertically. But real economic expansion did not justify the surge. When lending tightened, the illusion evaporated. The boom had planted the bust. In the decade before 2008, American household debt more than doubled. Mortgage balances tripled, yet median income barely moved, debt expanded, productivity crawled. The gap widened silently. That gap is the first warning sign. It never announces itself dramatically. It feels like opportunity, cheap credit, rising markets, easy approvals. But the larger the divergence becomes, the heavier the bridge grows, and weight always wins. But what happens when that excess credit doesn't spread evenly? Where does it actually go? And this is where the video takes a shocking turn. When credit grows too fast, it does not fall from the sky equally. It concentrates. It flows toward assets, homes, stocks, commercial property, financial instruments. And that concentration creates the second warning sign. Asset prices detach from reality. In moderation, rising prices are healthy. Markets anticipate the future. But when prices soar far beyond the income, rent, or earnings they produce, something unnatural is happening. Value is no longer a driving price. Liquidity is. In 1929, stock prices surged far beyond corporate earnings. Investors borrowed heavily to buy shares. Those shares became collateral for more borrowing, a circular machine. When fear entered the system, margin calls cascaded. Forced selling fed more selling. The Dow Jones collapsed nearly 90% over the following years. Not because companies vanished overnight, but because prices had been propped up by borrowed money. In Japan's late 80s surge, price-to-earnings ratios exceeded historical norms by multiples. Real estate yields dropped to levels that made no economic sense. When interest rates rose, asset values plunged for years. The stock market would not revisit its peak for decades. In the early 2000s, United States, housing prices in cities like Miami and Phoenix doubled within 5 years. Incomes did not. Lending standards deteriorated. Exotic mortgages masked risk. Meanwhile, the S&P 500 traded well above long-term valuation averages. Financial firms packaged mortgages into complex securities. Those securities generated enormous profits. Profits justified high stock prices. High stock prices justified more lending. The machine fed itself. But here's the danger few recognize. When asset prices depend on constant credit expansion, they become fragile. If borrowing slows, prices wobble. If borrowing stops, prices collapse, because there was never solid ground beneath them. Every bubble invents a story. In the 1920s, it was industrial supremacy. In Japan, it was management genius. In the 2000s, it was financial innovation and risk distribution. Each narrative explains why this time is different. Each narrative dulls skepticism. Psychologically, humans anchor to rising numbers. If your home rises in value every year, you feel wealthier. If your retirement account climbs, you feel secure, even if the gains exist only on paper. This illusion of prosperity is powerful. It silences doubt. It rewards risk-taking. It punishes caution. And then comes the moment when buyers disappear. Credit tightens. Confidence wavers. Prices fall faster than they rose. And the illusion shatters. But something even more destabilizing has been happening beneath the surface during this entire process. While asset owners celebrate gains, another part of the economy has been quietly weakening. Most people never hear the next part, and that's the real danger. The third warning sign is not found on a trading screen. It is found in paychecks. It is the widening gap between financial prosperity and everyday economic reality. When asset prices soar but wages stagnate, two separate economies form. One economy lives in stock portfolios, real estate holdings, and corporate profits. The other lives in rent payments, grocery bills, and medical expenses. Before the Great Depression, corporate profits were booming, yet agricultural incomes were falling. Industrial wages stagnated, wealth concentrated at the top. When downturn came, most households had no buffer. Consumption collapsed, businesses failed, unemployment surged to 25%. In the early 2000s, American corporate profits reached historic highs. The stock market recovered quickly after the dot-com crash. But median household income barely grew. Home ownership expanded, but through risky loans, adjustable rate mortgages, subprime lending, credit replaced wage growth. It felt like inclusion. It was leverage. When housing stalled and interest rates reset, defaults began at the bottom of the income ladder. Those defaults triggered losses in mortgage-backed securities. Those losses froze credit markets. Frozen credit triggered recession. The damage spread upward. The people with the least margin absorbed the first shock. Afterward, institutional investors bought foreclosed homes at steep discounts. Wealth reconcentrated. The cycle completed. This divergence is not accidental. When gains from credit expansion concentrate among asset holders, the majority must borrow to maintain living standards. Borrowing deepens the debt-to-output imbalance. The system becomes dependent on continued expansion. And here lies the structural trap. Policymakers face impossible choices. Allow a controlled slowdown, risking unemployment and political backlash. Allow a crash, risking systemic failure. Or inflate the system further, eroding purchasing power over time. Historically, the third path is often chosen first. Money supply expands, rates fall, time is purchased, but time borrowed must also be repaid. After the Great Depression, reforms like the Glass-Steagall Act attempted separation between commercial and investment banking. Decades later, those barriers eroded. After 2008, regulations strengthened oversight. Years later, portions weakened. Memory fades, incentives remain, growth pressures return, credit expands again, asset prices rise again, inequality widens again, the structure rebuilds itself. Not because of conspiracy, because incentives reward short-term stability over long-term resilience. Every participant behaves rationally individually. Collectively, the system drifts toward fragility. Credit outpaces productivity. Assets detach from fundamentals. Prosperity concentrates. Fragility, illusion, concentration. The pattern repeats across centuries. And here is the uncomfortable truth. The next collapse will not surprise those who study structure. It will surprise those who trusted surface stability. Timing cannot be predicted precisely, but warning signs can be observed. Look at debt growth relative to GDP. Look at valuations relative to earnings and income. Look at wage growth compared to asset growth. The data is public. The pattern is visible. The engineer in Pennsylvania wasn't reckless. He was inside a system whose foundation had been weakening for years. Understanding these warning signs is not pessimism. It is literacy. Because collapses do not begin with crashes. They begin with distortions. And distortions are measurable. If this kind of structural analysis matters to you, if you want to understand the architecture before the headlines arrive, subscribe to Economic Tales. This channel doesn't chase noise, it studies patterns, because the patterns never wait, and the next chapter is already being written.